Hello, Face. Everyone doing okay? Let's have a great week. Okay. Hi, Glenn. All right. Okay, so if you've been having a little trouble trading the dollar and the euro, look at this weekly before I get to the short-term stuff. Okay, looked like it broke out of a wedge, negated the breakout, and now so far no follow through to the failed breakout. So pretty choppy. Been choppy for a while. When I look at the 4-hour, perhaps we rally back to 1270. And, you know, to me, it looks like if I go with the trend, I think that we're going to attack these highs on the Dixie now, because the Dixie had a chance to turn bad down here. One thing I do know for sure with all the uncertainty I have here, and I think the dollar could pull back before it makes another attempt to charge to new highs, but this 200-day. So one thing I know for sure is that if we take out last week's lows, I think this was Monday, if we take that out and the 200-day, then you have a different story. And I believe that would be the wedge line that we showed on our blog. So until that time, I guess I have to give the benefit of the doubt to the trend that's been enforced, although labored. And that points towards the potential of a new high. But perhaps before that happens, we get some type of pullback here, 97.20 or so, and then make another run. And then if it's more than a pullback, I think you're going to know on the Dixie if we start taking out 97 again. And if we start taking 1280 out again on the euro. But I could see this just do this arithmetically, okay? So let's call this the range of some type of formation that's beginning to develop. Maybe it's going to be a right shoulder. If I have a bearish bias, we could rally back into this zone. And you'll know that we could enter an acceleration phase in euro to the downside by candles closing back under 112. Just like last week we talked about back under 1280, and Blake and I talked about, it's taking too long to accelerate, and then Friday really sealed it. Okay, it was playing around the wedge, and Friday sealed it to the downside. So I have to go with what happened Friday and sell rallies thinking that this was real, and if it gets back up there, there could be a rejection. Everyone with me? Hi, Russell. And the same scenario in the dollar. Yen, I'm guessing the Fed scenario is going to be they don't ease in June. I think retail sales were pretty good. Maybe they set the table for July, but perhaps there's going to be a little disappointment that, all the people that want hopium now are disappointed, and we still get some type of, this could have been Greg. Oh yeah, since I'm talking about what might be an ABC, since I really don't know Elliot, but I've learned like some simple things. Greg is going to be with us today. I know a lot of people have been asking, when's Greg going to be here? He will be here. So it's going to be a information-packed session here. So if the Fed does not ease, perhaps the risk off comes in and we get this pullback to 28.40 before launching to new highs. And if that happens, what I'm guessing right now, it's just a guess, is that we get one more shot down in the yen, down to 107.60, and that yields, it's counterintuitive because you would think if the Fed doesn't ease that yields would head up, and maybe that was the bottom in yields. But you also have it down here being contained, and we did not make a new low this week. Last week, we did the week before. We have two drives here, and so I'm thinking one more shot down with a little risk off. And I think that would be, I'm going to take a shot that yields are going to be bottoming out down here, above 2%, right around 2%. So one more shot down here would give me one more decline in the yen and one more shot down there. Everyone's pretty interested in what's happening in the metals. Silver's acting better than gold, putting in a higher low on the 1 hour. See this? Low, pull back, low. And the gold is at major support, this 1330 level. See this? And when I look at the 1 hour up here, pretty high momentum reading. So thinking one more low in yen, another high in gold, and perhaps this time, since silver's barely down, only down a penny and a half, that silver leads it this time. I don't see anything that bearish. It was a hell of a pullback, but you know, we still have this wedge that it hasn't negated, and we pulled back to it last week and held. And so far, this is temporary resistance. If we get through this 1510 level, you know, then we're looking at halfway back, maybe 1580. And eventually, if the wedge is true, be true to me, wedge, we could see the top of the wedge being accomplished. Okay. Any questions on my coverage of the markets this morning before I hand it over to Blake and the rest of the team that puts together the best website and community on the net that you would be really serving yourself to become part of? Any questions? I have the chat box open. Okay, and you want to talk to our sponsor. So you have a little supplementary income that either goes into your pocket or pays for the subscription, and you get a hold of Trent and Justin. They have many selections for you. It's also okay to have multiple accounts. I know many people do it for different reasons. Some have day trading accounts. Some have swing accounts too, and position accounts. Okay, so talk to these guys. They sponsor this webinar. Them and us are making this possible and paying the freight to serve the interests of the Forex trading community here. And in my extremely accurate and humble opinion, I think it's the most compelling, information-packed webinar on the net, free or paid. Okay, so you know, most people would pay $100 a month for a room like this, an hour and a half a day. I do have an interesting interview with a paranoid bull. Maybe it's a good time for some of the other bulls to start getting paranoid. So we'll be talking to our guest at the top of the hour. Wishing everyone much success this week. Have a warrior mentality. If you're thinking to yourself right now, before you click your mouse, I hope this one works, stop trading. Approach the market with, I've done my work. I know why I'm getting in. I know where I'm wrong. I know when I'm right, what I'm looking for. Go ahead, Mr. Market. I challenge you to prove me wrong. Don't feel challenged by the markets. Challenge the markets. And if you've done your work, you're going to have the confidence and conviction to do it, win, lose, or draw. How's your weekend, Blake? I'm pretty sure you're watching the U.S. Open.
Yeah, you know, I watched a lot of the Open over the weekend. It was a good tournament. I thought Koepka was going to come in and try to do his three-peat, but he played solid golf. It was a good tournament. I didn't get to watch yesterday because it was Father's Day, and we had plans all day with family. So, and that was a really nice day yesterday, and really enjoyed my Father's Day. Hope those of you that are fathers out there enjoyed your Father's Day as well. But overall, a good weekend, nice and relaxing weekend after some mayhem over the last couple of weeks with Disney. So it's nice to have been kind of chill. So what's going on over there? I've listened to your analysis, and I want to talk a little bit about. Let me go ahead and I want to talk a little bit about that you mentioned, Dale. You talked a little bit about precious metals, right?
Yeah.
Okay, so talking about precious metals, and you're talking about gold. I was just thinking gold. I mean, we are up against really key resistance. We did come off, and we put in a nice reversal candle on Friday.
Yeah.
At the end of the day, a little false breakout. This is a long upper shadow doji, which, it's almost like a shooting star, but it's more of a neutral candle. But still, being that it was a false breakout, got to be a little careful with it. But I think everybody here knows that, if we break out above 1360, it's gone. Gold is going to take off. And that's where, and I know I talked about this over the weekend with the week ahead video, but that's really going to be the catalyst that drives me to believe that we're going to see continued dollar weakness. Now, continued dollar weakness would be the euro moving higher, and whether it's the euro moving higher or the dollar index moving lower, whatever it may be, gold is really going to solidify that for me. The flip side to that is if gold does reverse, then then the dollar might actually see new highs. And remember, this all hinges now
On the Fed.
on the Fed, right, on Wednesday.
Mm-hmm.
That's it. Plain and simple.
Just one counterpoint, Blake. Last week the dollar was firm, right? Came back all week.
Mm-hmm.
And gold had if you look at the 2 weekly candles, you wouldn't think it made sense. Gold had a nice weekly candle, and so did the dollar.
Yeah, no, and I get what I know where you're going with this, but I think, excuse my
okay, buddy.
my yawning. I didn't sleep particularly well last night. So, but my thought process here is, if gold breaks out, this is going to be a massive breakout. I mean, this is not like a we're getting some sort of the
whole world is looking at that line.
Yeah, exactly. It's gonna be a big breakout. So when there is a big breakout in the market, whatever asset class you're looking at, whether you're looking at the S&P or you're looking at gold or at the dollar index, whatever, I always think about the domino effect. And the domino effect is, okay, what correlates strongest with gold, and where's that going to move? So in other words, if gold breaks out, if it actually breaks out, and let's say, we take out 1370, then we take out 1380 or 1360, then we take out 1370, 1375 or whatever this is, and we start actually really moving, we actually start breaking out like this, then what is the asset class that's going to be driven by a big breakout? Because that to me is the dollar, and that means the dollar is going to probably be weaker. And really, that's what I'm looking at going into the FOMC. It's like, if I'm kind of questioning,
you think they're going to hold back and just set the table for July, Blake, from the people you've talked to?
Yeah, I mean, I think that's what's going to happen. I don't think they're going to. I don't think they're going to cut, and I don't think they're going to. I think they're. But the question is, even if they don't cut, which is fine, are they going to be dovish enough to really give us the reason to believe there are more than 2 more rate cuts coming in the future, July and into the end of the year, because we have the next meeting at the end of July. I think it's July 30th or something like that. And so, and then beyond. So if we come out of today or this week's meeting and we believe that there's going to be more than, excuse me, just 2 rate cuts, then the dollar may actually continue to weaken, and we'd see a breakout in gold. So that, to me, it's like, but I'll let gold do the talking for me. It's not, I don't have to sit here and try to dice the FOMC statement and try to figure it out. It's really, gold's going to tell me what I need to do. It's not I don't think it needs to be any more complicated than that, because what a lot of traders try to do is decipher the
Correlations.
well, not just that, they try to decipher the you know the meeting and what's being said, and how dovish is the statement, and let the market tell you.
Remember the briefcase indicator, bro?
Yeah,
Where
the
everyone
briefcase,
looked at
Alan
briefcase.
Greenspan's briefs. We don't have the briefcase indicator anymore, when it was so, briefcase indicator was so big that we knew that we had to start looking to sell dollars or whatever. I forget what all the, it was.
If
but
it was
yeah.
stuffed and papers were coming out of it, or it was thin, that's what people looked at.
Right.
Briefcase.
So it was silly, but anyway, we don't have that anymore. We haven't had that for a few Fed governors, but anyway, so I'm just looking at gold. I'm paying very, very close attention to gold.
I think we're going to break out, Blake.
You think we're going to break out in gold?
Yeah, I do.
Then okay. So that, with that being said, if that is your thought, then you were talking about the dollar. So do you think then that the dollar is actually going to come under pressure? Because this is part of my analysis from the weekend. So let me get rid of this.
I have more conviction about gold making a new high and one more low in US dollar yen and one more low in US dollar yield than I do in the dollar.
Okay. So with that being said, that means the dollar should actually reverse then.
Right.
If gold truly makes a move, then we should see the dollar actually break this 200-day moving average and this up sloping trend line. And I'm in that camp as well. What I'd like to do, one of the things that I'd like to do, and let me kind of give you my thought process over the course of the next couple of days. If the Fed is dovish, how do you think the market is going to react with a dovish Fed? Okay, let's put it all together. All right, if we have a dovish Fed, is that going to support equities or make equities break down? What do you think, Dale?
It should support the market to challenge all-time highs.
Okay, so if we have a dovish Fed, and the market feels that the Fed's going to be looser for longer, the stock market that you see right here at the S&P, we should challenge all-time highs. I agree with that. I agree with that that analysis, and I don't know where this D came from, so let me go ahead and get rid of it. So we should challenge all-time highs. Great. And if we stay looser for longer, what does that do to inflation expectations?
Yeah, it increases them.
Increases inflation expectations. So in the one of the biggest hedges to inflation, according to the markets, is gold, right? Gold.
Except look, it's the gold silver ratio might be beginning to turn. It's been on such a tear for such a long time, gold outperforming silver, that I have a chart of it, and if I was sitting on a ton of physical right now, I'd be exchanging gold for silver at least a little bit. I'd be liquidating my gold and buying silver on this ratio up here.
And typically, with that being said, Dale, if silver outperforms gold, that tends to be more bullish for the whole metals complex anyway.
Yeah.
Right.
Yeah.
And so I get what you're saying, and I think that's a good possibility.
They're all just guesses, man.
No, and this is I'm trying to put together a battle plan between now and Wednesday. This is it all plays through. So if you think equities are going to move higher and you think gold's going to move lower, or excuse me, if equities are going to move higher, gold's going to move higher, silver's going to move higher, the dollar index is going to move.
Equities will be disappointed by them not cutting, and even if they make a dovish statement, I think equities could pull back and then ramp into the July thing. But I'm thinking there might be a little risk off because the market is hoping for I don't know if the statement's going to do it. I don't think they're going to ease, but maybe the statement isn't as dovish. I don't know. All I know is it looks to me like S&Ps could pull back, and there could be a little risk off because of disappointment over the Fed. Is kind of my guess.
Okay,
That the
so
market might be disappointed.
but I'm going to go with the argument that the Fed
Dovish.
is going to be dovish,
Okay.
and equities rally,
Okay.
gold rallies, the dollar index sells off.
Okay.
So what would be the best currency to trade if you have gold rallying, stocks rallying, dollar selling off? And when I say dollar selling off, it wouldn't be against the yen. It would be the dollar selling off against the euro and other, you know.
How about
other
Aussie?
Oh, we're talking. How about Aussie? So and I've been looking at the Aussie dollar, and this is a currency pair that is trading heavy. But if you look at this hourly, all right, and you look at this low right here, okay, the low from, you know, back in May to the high, okay, and then you take this last up move to the high, we have a confluence of 127% extension of the entire move here, okay, 161% extension of this last move up. They all come in at 68.20, so that's 50 pips lower than where we're currently at. In the event the Aussie breaks through the support, there's a good chance, in my opinion, that if we break through the support, the Aussie is going to start taking out, you know, it's going to, you know, drive down towards, you know, take out a bunch of stops, drive down towards this this fib confluence, right, at 68.20. Now, tonight we have the RBA meeting minutes, and that happens 6:30 my time, so it's going to be at 9:30 Eastern. So what I'm hoping is going to happen is the RBA meeting minutes read a little dovish tonight, and the market takes the Aussie lower. I'm hoping, right? And the Aussie drives through the support and comes down to test 68.25. I am actually looking to buy Aussie dollars down here ahead of the FOMC, and hopefully tonight, tomorrow, we get a little bit of a bounce, and then you know, we bounce back towards, you know, towards like maybe the breakdown point or something, and then the Fed comes out, and let's say the Fed's a little bit more dovish, and gold rallies, stocks rally, silver rallies, the dollar sells off, and then you get an Aussie that actually by the end of the week trades up towards 69 cents. So that is my plan. Now, I plan trades all the time. And if you guys think that my plans work out each and every time, you're crazy. I think about like what I want to do, how I want it to play out, and I'm lucky if 20 or 30% of the time things work out the way that I had planned. But when they do work out the way that I have planned, my conviction is very strong. So right now, I'm looking for a dip in the Aussie dollar to 69 and a quarter, because I think if I can buy it down there, I've got very manageable risk for a potential long in the Aussie, and then I get to play it back to the upside. So that's how I'm planning the Aussie trade. Now, and one of the things that could obviously happen from here is that we don't break down. You know, the Aussie, the meeting minutes might actually be, you know, not dovish, and, you know, it doesn't really end up moving the market. You know, we end up holding this 68.60, and next thing you know is we start rallying, which is entirely possible. And then we set up a double bottom, or, you know, just, you know, we have a lot of strong support down here. But I'll be watching the Aussie dollar tonight during the FOMC meeting minute, or during the RBA meeting minutes, which, like I said, is at 9:30 Eastern, 6:30 my time, being you know, Pacific time zone right now, and seeing if I can play it that way. Now, I'm gonna see if there are any questions, or let me see, where's my chat box? I haven't even looked. Where's the Rio said dollar Swiss. Gerald said gold. I guess you guys are probably asking or answering my questions, like what I was asking there. But where is the chat? Oh, here's the chat. Let me see the chat. Let me ask: does that make sense to you guys on what I'm trying to do with the Aussie? Does that all make sense? Claudio asked, "What's your take on Bitcoin?" You know, I don't have a very big opinion on Bitcoin because I've missed this most recent move. But if you look at Bitcoin, I was looking at a potential head and shoulder pattern. We've rallied towards the top of the what I feel is the resistance zone, which is going to be somewhere up here. But if you look at like you take the all-time highs, if you will, to the lows, we're probably getting pretty close, I would assume, to the 38% retracement. So let me go ahead and let me do this. Nope, that's not what I want to do. There we go. So as you can see, we're right up against a 38% retracement longer term at 94.80. So my 2 cents is I wouldn't be chasing it up here. We have divergent relative strength, and it's it's right up against resistance. Like, if I was long, if I wanted to be long, which I wouldn't want to be short. Let me just put it that way. I'm not in the camp of shorting Bitcoin because I really don't know how to play it. But obviously, the momentum to the upside has been great as of the last couple of months, so I wouldn't want to fade it. Not with anything that I see here, especially that we continue to make higher highs and higher lows. So there's no reason to be fading it at this point because, like I said, I don't have a great understanding of it. So, but if I was long, I'd be very concerned because we're almost at that 30. You can see the 38% retracement is right here. Let me grab my drawing tool. Give me 1 second. So here is the, where is my pen? Here we go. So right here is the, you can see the 38% retracement right here, right? That's a 38% retracement. You can see relative strength is divergent. So we're hitting new highs. I don't like this color. Let me change the color. And let me clear the drawings right now. Okay, so here's your 38. I don't like that color either. Okay, let me change that again. Erase, clear all drawings. Okay. So you have your 38% retracement right here. You're hitting new highs in price. Relative strength is divergent. So I wouldn't want to be chasing price up here. But as you can see, we have higher highs, higher lows. So there's no reason to be fading it either. So what I'm trying to explain to you right now is there's no trade in Bitcoin, in my opinion, if you want to be on the long side. If you want to be on the short side, you want to try to fade the strength, you can go ahead and, probably sell it up here and, put your stops above like 10,000 or 9,500 or something, and if you want to try to take a pop shot at it going counter trend, but that's pretty risky in my opinion. So anyway, just giving you my thoughts on Bitcoin since you asked. Hey, this euro, let me go ahead and I'm going to go back over to the euro dollar really quick. So here's the euro. There's a double bottom here intraday. We should top out probably at this 112.50. So if you guys are looking to, if you're looking to sell the euro, I think trying to sell it up towards 112.45 to 112.50 is probably the better trade right now if you missed that move. Let's see. I think we have data coming out. New York Fed manufacturing coming out here in just a second. Oops. So let's see what happens with this euro here. See if we get any type of activity. It's weak, so the euro should push. Oh yeah, we're pushing towards 40. And you might get a little bit of a fade here. Let's see if we can make it up towards maybe 50. Cable just broke 126.
Getting a negative 4-hour candle on, well, it's not closed yet, but US dollar yen.
Yeah. All right. So we'll be careful with the. So here goes the. Remember, we had just had a double bottom completion. I just actually sold some euro at 46. I'm going to cover it. Try to cover it below 40. I personally just shorted it. So I sold 46. I'm going to see if I can cover it down here. Actually, I'll just take 5 pips off the table. I just closed it at 41. So I just closed it for a real quick gain. But yeah, once you complete the double bottom here, that's a 1-minute chart. So once you complete that double bottom, it's like, I wouldn't want to chase it up there. So I just faded it really quick, but I don't know how much downside there's going to be after that week of a number. I think what you can do at this point is just see how the euro responds once we get up to 112.50. You know, if it gets up to 112.50, you know, see where it goes. If it really stalls up here, then you can, you know, I think I wouldn't mind trying to sell it again. But anyway, all right. Well, there's that. Hey, you guys are in for a real treat today. We have Gregor Horvat coming in. Steve, it is a holiday in Greece today. And I always like to joke with these guys because it seems like it's a holiday in Greece almost every day. But because it's a holiday in Greece, Steve took some time off with his wife, and for that, Greg is going to be popping in today to help join in. So let's see here, Dale.
Yeah, buddy.
So what do you think we should do from here?
Well, gold's coming out of here. I'm looking for this pop in the gold, the break in the end. So far,
yeah, but do you really think we're gonna get? Do you think we're gonna get much of a move ahead of the FOMC? Because I don't think so. I mean,
no, I mean, yeah, you know, I think people are book squaring. I'm just looking at the charts, and you know, gold held that 1330 level, which if it takes it out, then the picture changes for me. Silver is actually higher on the day. So, you know, my theory so far is working, but I could throw it all out the window on Wednesday. My theory.
Why is 1330 a big important support for you?
I have some moving averages there, and that's the main reason. And also the 1 hour gold confirmed the highs. So I rarely see markets peak when momentum is confirming the high. So, but 1330, if you notice on the gold, has kind of been a pivot point. You see a lot of touches there. So to me, it looks significant. Actually, 1332 to 1330.
Yeah, and
you want me to show it?
Yeah, I mean, if you want to, yeah, you can.
Yeah,
you can show
I don't need to, but
well,
anyway.
So just looking at gold and looking at this 1330.
So you have a moving average. What time frame? That's a 1 hour.
That's a 200 period moving average.
Okay, so if you go the 4 hour, you'll see the 50 right there too. There you go.
Yeah.
Okay. So there's confluence on different time frames at the different price with different averages. To me, that usually means something.
Got it. And you know, I looking at gold, my 2 cents here is that as long as we continue to make higher lows, so you just look at this hourly chart. If I was long gold, which I'm not, but I'm just saying, if I was long gold, I wouldn't want to see it trade below this low, which is 1319. So my opinion is that between now and Wednesday, we shouldn't break below that. We might do this. Let me just, we might, do this and do that, between now and Wednesday, but we really shouldn't break below these hourly lows. If we do break below these hourly lows following the FOMC, that's going to be a trigger to me that gold is, you can officially stick a fork in it. It's done from here. You can, probably short it all the way back down below 1300 without much of an issue. And that's how I'm going to be playing it going into the FOMC. Is I'm going to be thinking about it being a possible long candidate while we're above this support. We get below 1320. I wouldn't want to be long gold. I probably wouldn't want to be short the dollar either in that situation. So that's why I'm going to be paying real close attention to gold around there. And let's see what silver's doing here. So silver continues to hold up pretty well too. I like your descending wedge. I didn't have it as a wedge, Dale.
Yeah.
On silver, I had it more of a channel, but I see exactly what you're saying, and I agree with you too. I mean, whether you look at it like this or whether you look at it like, actually, the wedge that you have,
and your big trend line comes in up around there. Your big blue trend line up above.
Oh, up here, yeah. That's going to be, it's going to be real significant, and I'm really just focusing on 1511.
Okay.
And if 1511, breaks, to the upside, I think that's going to seal the deal that that silver is indeed going to be moving higher. So Greg is trying to sign into Zoom. So let's see. Is
he having trouble?
Let's see here. Yeah.
It's pretty simple.
I'm telling Gregor right now he can just log in as a participant. Just give me a second, and then we can bring him over. He should get an email. Well, I'll talk to him when he gets here because this is the first time he's logging into Zoom. So,
yeah.
So, and you guys have to bear with us. We just started using the Zoom product for our webinars just over the course of the last few weeks. So, and Greg hasn't joined us for a while because he's got kids this time of day. He's with he tends to be with his kids in the afternoon. So
Andre's Paulie's volunteering if he can.
Yeah.
Get in.
Let me see if I can unmute Paulie really quick. Paulie, you there?
We have so many volunteers here. We
it's-
should be from Tennessee, the Vol State.
Hello, Billy.
Hey, Paul Franco, how you doing?
Hey, I'm doing good. I'm actually watching the webinar, which I usually do on my Mac. So if I pop in and share the charts, I'll have to log out and pop back into the on my regular computer. But I was telling the guys in the webinar this morning, the European crossover, I'm in complete accord with you on the idea on the FOMC. And really, that's why I think you're seeing the dollar sell off, and that's what we're looking for. The risk is, and I put on that in the chat room, whether you're a dollar bear or dollar bull, the dollar's going to have to pull back as we go into the FOMC. And my thoughts are that they are going to be dovish. I didn't even realize on Tuesday, the percentages on the Fed rate tool was, I think it was 17%.
Wait, hold on, real quick before I'm sorry, I hate to interrupt you. Dale.
Yeah.
Do you know how to make an attendee? Because Greg is over in attendees. Do you know how to bring him over?
Sure.
Do you want to do that? Okay.
Yeah,
Sorry, Paul. Go ahead.
Oh, no, what I was going to say is that I think they are going to have to be dovish. I think that they will be dovish. The risk would be that there would be a cut, and that's been the one thing, since y'all been talking about gold, that has propelled gold, and why a couple of weeks ago when I was talking to some of you guys in the room when we had our meeting, I thought the gold was really going to take off because of the anticipation that rates would be falling, and we saw rates continue to fall lower because back in December and early January, the case was being made. I made it myself. Gold was a great, opportunity to move into because of shedding some of the risk or offsetting some of the risk from equities, but gold didn't move that much. And when the dollar fell, gold still didn't move that much. But once rates started to fall, gold really started to take off. And if the Fed does take action, or if the Fed gets dovish, I think, as you were saying, I think gold's going to take off like gangbusters, and we will then see the dollar pull back. But,
me too. I agree with that. Hey, Grega actually just took over the screen. And how you doing, Grega? Let's see if he can talk right now.
Hey, I'm here.
Hey, what's happening? So, hey, welcome to Zoom.
Yeah, I have been in Zoom already earlier, but
Oh, you have? Okay.
yeah, just not sure where I have my login details, or maybe we did it the same like today. So,
well,
anyway.
It's good to hear from you, and I'm actually gonna. I know everybody wants to hear what you have to say, so I'm going to let you go ahead with your analysis. But it's good to hear, good to see you, and thanks for coming in today.
My pleasure.
Hello, Wizard. Nice
Hey.
to. Looking forward to seeing where your head's at, man.
Yeah, I mean, if you look at the euro dollar, should be any difference compared to the 1 week, 1 month, 2 month back? Probably not. I mean, it's still a very ugly price action overall. Some very important decisions could be made very soon here based on technical perspective. I mean, there is a very strong divergence clearly on the RSI compared to the price, and price actually is showing potential ending diagonal here for wave 5. So in my opinion, I still think that the recovery can occur. The only question is if already from here. What I like about this timing right now is that actually we are on the 4-hour chart, we are turning up from very important intraday support here. It was some spike last week at 1200 level, from where we are now reversing slightly to the upside. And if price would be able to rise towards 1290, then I think more upside will be in play for the euro dollar. Also, when I'm covering euro dollar, I want to look at the dollar index. Notice this channel, which I think it's very important. We have tested this lower trend line support a few times in this uptrend. 1, 2, 3, 4, 5, 6 times, and then we finally saw this very strong push to the downside. And now we are back at this trend line that could actually turn into resistance. And this could be a perfect timing for, if dollar is really going to weaken from here, then we should see this happening this week for sure. Also on the short-term charts here, we can see some very important resistance. We have recovered for 60% compared to the previous decline. Also, we have plenty of this previous swing low that can act as a resistance, swing high as well here. So I think it's a very important do-die zone for dollar, and if bears will stay alive here, then I think that euro could really see more upside. And as you know, normally those ending diagonals, okay, provide a very strong and sharp price. So I'm prepared on any surprise here with much higher prices for wave A for sure. Also, if we, in this context, if we cover dollar Swiss, then obviously Swiss franc, we would expect that Swiss franc will be stronger if we think the dollar index will move to the downside. And what I see here is 5 waves of decline, waves 1, 2, 3, 4, 5. And more importantly, now you have only 3 waves to the upside, right into this resistance, this falling trend line, and also previous swing low, okay, of this that was actually representing wave 3. Of course, there can be a pullback when you track an ABC. There can be a pullback back to the termination point of the previous wave 4, okay, but that may not be the case if you see a very strong and sharp wave 5, like in our case. So I'm prepared to see maybe top formation for wave B a little bit earlier than some way things. So we are here at 38.2%. Also, we are around parity, very important psychological level as well. So I would not be surprised if we see a reversal to the downside here. And actually, this matchups perfectly with the euro dollar. Also, if we take a look at some of commodity currencies, let me take a look on Aussie. Aussie is clearly in a downtrend, no doubt, but I think there can be more upside since we have seen this spike at the start of the year. And as you know, this spike, this decline, and then reversal to the upside were very sharp. So it's not a surprise that market is actually now slowing down, but ideally for a correction. We have plenty of overlaps here on the way down. It's a 7 swing move, so probably a correction. But of course, 78.6% is the level, the final fib level from where I want to see a bounce. So if we see a 5-wave recovery there on a smaller time frame chart, then I would be even willing to look for potential longs here, especially if gold will also stay in uptrend. Okay, so if we take a look on the 4-hour here, the fib levels that I'm looking are at 67.70 up to 68.20. Now that's the area from where I would like to see a bounce in 5 waves. At the same time, obviously, I will keep an eye on this upper trend line resistance. If we can take this out, then I would be even more confident that maybe we are headed to the upside. Now, since I mentioned gold, let's take a look on gold. Okay, so Dale, are you here? Anyway, so Dale will know that on gold we have been tracking 2 wave counts, and I'm actually still tracking 2 counts. It's a very tricky but very important, very tricky price movement, but very important level at the moment. Okay, so on the left you can see we have 5 waves to the downside, and on the right we have 5 waves to the downside. So we know that longer term gold is still in downtrend. The only question is what type of correction this current wave B will form. Will this be only a triangle like an A, B, C, D, E, and we are now going to complete this pattern? Or are we going to see an A, B, C rise for higher prices into wave B? Well, it's do or die zone because we are at the upper trend line resistance. Okay, so I don't want to be too smart here, but what is important when you don't have enough of clear price action on the higher time frame chart, you go and look for a clear pattern on the lower time frame charts. And if you look at the daily chart, well, I see here an incomplete recovery up from May levels. As you know, always when you have a completed correction like here, this drop, then this correction, if it's reversed by very strong move, it's normally an impulse. If it's an impulse, it should be made by 5 waves. And this is not the case yet. This is waves 1, 2, nice extended wave 3. Now we can be a wave 4, so I see more upside, at least for another push higher into wave 5. The only question is how far will this price, this wave 5 take us? Will it cause the breakout on a weekly to the upside above this weekly trend line or not? But in the short term, I think that more upside could be seen after this wave 4 pullback, or after this retracement. Now here is also 4-hour chart. Very important levels on the way down that I would keep an eye on are 1320 up to 1325, of course, after a 3-wave setback. Okay, so if this would play out, then maybe that's also going to be a timing when maybe Aussie will finally catch the beat as well. Okay. Now let's take a look also on silver, since they are correlated. Silver is maybe showing an even better, clearer bullish structure. Okay, here on the 4-hour, we have seen a downtrend that has been reversed recently by this very nice breakout, clear breakout with an impulsive personality. Okay, we also took not only 1 but 2 or 3 swing highs of the previous downtrend. So that's a change in trend, and if that's the case, then as you know, recovery should be made by minimum 3 waves. Ideally, we are now in a wave B, and so far this is unfolding very nicely. This could be wave A. Zoom this. Wave A. This could be now wave B. So watch out for 61.8%, which means another spike below that level would actually come in play. And that's I believe, very similar zone compared to the gold, and also timing could be very similar, obviously. So when gold completes wave 4, that's when silver could complete this wave B. Okay, but don't get confused by this intraday bullish scenario here on metals. I mean, at least silver is still on a longer picture, a longer time frame. It's still in a downtrend. We are just consolidating, and I think that another drop will occur after after this completed triangle in a wave B. Okay, so gold, silver could see more upside. Obviously, this would come in play another confirmation why actually dollar index could come down from that resistance. Okay, that's probably the most important chart for me, at least for this week. Okay, we'll see how it plays out. If we're starting to see just rising here on the hour chart back towards 98, then obviously I would adjust the view, but still I would be looking for a top formation at a new high, for potential top formation at a new high, because I see prices here at the end of this 5-wave cycle that is underway since February, actually. Okay, now let's take a look also on stocks. Now the S&P 500, I have been warning about this for a while, that always when you see a very strong pullback, very strong retracement, you should be aware of even more upside on stocks, because this has always proved to be correct for the last 10 years. So I definitely do not want to fight the trend. I'm still looking for more upside here, see room for a wave 5. As you can see, my 5 targets are at 3,500, around there. And this recent development just confirmed that actually we should stay bullish. Why? Because this pullback unfolded clearly in 3 waves. And this was actually a textbook example. We have seen previously a 5-wave recovery, a 3-wave pullback, exactly back to the area of the former wave 4, which is normal when you have an extended wave 3. Also, we have touched this 38.2%. Wave C was very similar to wave A. We have very nice break to the upside, very nice turn, clearly a strong move higher, which means more upside, more gains should follow after a pullback. Okay, so on the 4-hour chart, or maybe even better on the intraday 30-minute chart, I see this current development as a corrective movement. Okay, now the only question is if this is wave 4, which I think could be a wave 4, it already found the bottom here at 28.66. Or is this going to be a triangle, which means more complex, longer correction, but still in the contracting range before market explodes to the upside? But definitely I want to stay bullish here, okay? Not only the S&P 500, even DAX, which as you know is trading far away from its all-time highs, is showing bullish development. Firstly, monthly chart, clearly, I mean, definitely I want to stay with this trend, because after each very deep pullback, as I already said before, market recovered back to new all-time highs. So I want to stay with this type of a path. I want to look in this direction. On the daily chart, this recent pullback I labeled as a wave 4, could be also higher degree wave 2 maybe, but the important is that in both cases, we should be looking for a reversal or for a move back to these May highs. Because on the 4-hour here, you can see clearly an ABC decline, very important break or push above this trend line, and now we are pulling back. And this pullback already shows possibly an ABC structure. But I want to see a little bit, maybe a little bit lower prices still earlier in the week. And the support, also a very important second support, is still at this 11,900 area. So maybe we should watch out for this support if 12,040 is going to be broken at the start of this week. But nonetheless, I mean, no matter how deep we go here, I will label this as a counter-trend movement weekend uptrend unless we see this 11,600 22 level broken, which was actually at this gap area here back from March. So obviously this was a very important level for a bounce. Okay, so DAX, I'm bullish, but expecting slightly weaker, lower prices, and then a recovery back towards these levels. Also, what is really interesting is probably Pound Aussie. Pound Aussie, we covered with Steve this one a week or two back. We discussed this clearly. This pair is in a downtrend, down from 2015 highs. Now it looks like a correction. If you're familiar with the Elliott wave principle and waves and personality of each wave and so on, then I'm sure you would label this as a corrective movement. So this is what I call a clear pattern, okay? It suggests a temporary rise, and I'm expecting a breakout. Not only a breakdown, not only that, on the daily chart here on the right, you can see that this potential top formation, if top is already in place, has been made by an ending diagonal here, okay? And this trend line, lower super line, has already been broken, and we are now retesting it from the outside. So ideally, we'll see a continuation to the downside, and actually this could come in play if Aussie will really find the support at those levels that I showed you earlier against the US dollar. Okay, so I'm definitely watching this one very closely. Even Pound Kiwi is very interesting in a similar pattern. Notice clear 5-wave drop and then a very deep and complex corrective recovery up to this psychological level, 2.0 level. That's why I'm always highlighting the psychological levels, because round figures can provide some very interesting swings or shifts in the market. We have, after that touch up there, we have seen a nice reversal to the downside. This trend line has been broken. It looks like even more weakness could be following after a completed correction. We are now still probably only in a wave, let's say on a sub-wave A, B, expecting wave C. Watch out for resistance here at the previous swing high, okay? This swing high, I think, would be very important. So 1.9540, definitely watch this one, okay? Maybe even some kind of a head and shoulders top could be building up there. Okay, so what we have, 3 minutes left. I'm sure we have some interview later. So
I'm not sure, Greg. You know, a lot of people think they could call in. I think my guest today thinks he could call in too. So I don't see him. David Levine, if you're here, can you send a question? Go ahead.
Yeah, sure. I will still cover crude oil. Okay?
Yeah, go ahead.
So as you know, Dale, we covered this chart at the end of 2018 when we said that always or each time since 2007 when crude oil, when energy prices have been declining into the year end, then we have seen a recovery at the start of the following year, at the start of the next year. And this has been the case in 2007, 2009.
Yeah, I remember that analog you used that accurately called the low at the beginning of this year too.
Yes, and so far we have, as you know, we made a very nice, quite, let's say also unexpected, very strong recovery, I should say. But still, it followed the pattern perfectly, but now we are again in a new cycle, it appears. Notice that actually this rise, this recovery has stopped at this previously broken trend line. And now we are falling quite aggressively away from there. Also, this has been, or there has been 61.8% of the previous decline. And plus, we have these former swing lows that acted as a resistance here. So, as you know, when important support is broken and maybe retested as a resistance could make a new continuation lower. And another thing that is important with this current chart is, and decline, is that market move into this territory of this wave A or wave B if you want. So let's assume that you were bullish, okay, and you would say that this was previously wave 1, 2, 3, 4, you would expect a wave 5. Well, you know that prices must not trade into of a wave 4 must not trade into territory for wave 2. So in such case, any bullish interpretation has been invalidated. And that's why I like this bearish interpretation even more, because it confirms that actually market made only a deep corrective recovery. If we look at the heating oil here, it also, I mean, it's a very nice pattern. Strong drop, recovery, which could be labeled maybe even as an ending diagonal for wave C, or you could label it as a WXY pattern, but still in both cases, we have seen a very nice strong drop. And it looks like that we are now just posing for a correction on the way down. So I think that more weakness could be coming, even in crude oil. So if you take a look on the 4-hour chart here, let me zoom this in. What I see here is wave 1, 2, extended wave 3. Notice that this wave 3 caused breakdown right there below this trend line support, channel support, which was actually a parallel trend line of the upper trend line. So this is a base channeling technique. If you are familiar with the Elliott wave, Google Jeffrey Kennedy channeling technique. From the Elliott wave international, you will find a lot of useful stuff from him. So when this trend line is broken, it's normally confirmation for an extended and very strong move for a wave 3. And after wave 3 is completed, you may see a slow price action and retest of the same trend line that could act as a resistance in a wave 4. So I think that wave 4 could see a more upside. As you know, also 38.2% is very important level, fib level when comparing to wave 3, which is still haven't been touched yet. So watch out for 55 up to 56 level to be a very potentially interesting resistance zone for a new reversal to the downside for a wave 5. And actually, this wave C could come in play at the same time when we see push higher on stocks into that wave 5 that I showed you on the S&P 500.
Okay, buddy. Nice look. What would happen if what would your look be if we didn't rally now for a C and we made a new low and then rallied?
Then I would probably label this as a, maybe if we were just continuing to see sideways a little bit more, then I would probably label this as a wave 4 triangle.
Okay.
And then wave 5 here, and then expect a 3-wave recovery. But
okay.
This would not change my
right.
midterm or long-term view. I think that people is still on the way down. It's just the question where resistance will be tested.
Beautiful. Thank you so much, Grega.
Thank you.
Great to have you back, man. I really miss you when you're not around. Just want to let you know. And, you know, people here in Face go, when's Grega going to be here? When's Grega going to be here? So you made a lot of people happy here today. You're, you know, people.
Excellent.
I say, you know what? If you want to know what Grega's doing all the time, subscribe to ForexAnalytix or to your service. And then they don't have to wait for you to be here in Face. What do you think?
Yeah, and there are charts every day.
Pretty good idea. I mean, it's simple to solve that issue. You want to know what Greg is thinking every day? Subscribe. All time frames, many instruments, the whole deal. So thank you, Greg. A good hunting on the Fed this week.
Thank you.
All right, buddy. So you're welcome, man. So David, I see you. And I'm going to promote you to panelists. I'm not sure if you're going to be sharing a screen. I think you told me no, but we should be able to see you, and I hear you anyway. And
can you hear me now? Hi.
Hi, David.
Dale.
How are you?
I'm doing great, and really glad to be on. And I apologize if there's any kind of background noise, but I'm really excited to be on, and great to connect with you this morning.
Yeah, so you're waiting for the train. I like my commute, David. Which one room to another, and which bathrobe should I wear? So, so, buddy, why don't you tell us a little bit? I went to did a little work and took a look at your blog and a little bit of your commentary under your Twitter handle. So. I have a little bit of a feel for, where your head's at when it comes to markets and the economy. You're a veteran. You've been around through a few different cycles. Why don't you tell us about your first job in the trading, investing business. How did you get started? Tell us a little bit about point A, and now you're at point B. How did it happen for you?
Sure. So my first, going back, during the dot-com bubble, I was sitting in my dorm room in college trying to get into the bubble and doing a bad job at day trading. Going back, 2 cycles, and then I ended up coming to New York and started out actually doing M&A at a company formerly known as Lehman Brothers back in the day. So I experienced that crash. I actually lived a couple blocks away during 9/11. So I was kind of part of the first crash of my career. On the investment banking side of the world was learning about trading, but really kind of coming at it from the perspective of advising companies, and that then shifted over to to the buy side of things, in the last up cycle, kind of the 2001, 2002, 2003 timeframe. Moved over to the private equity world, and experienced what I would only refer to as a lesser version of the obscene credit cycle that we're experiencing today. As an allocator, so we were buying companies and rolling them up. And I ended up, I'd gone to school in undergrad to study philosophy and finance, but I went back to graduate school. I went to Harvard and I did a JD and an MBA because I wanted to kind of move over to the hedge fund world. So I went to Harvard.
Okay.
I focused on distressed. I actually was a research assistant and TA for now Senator Warren, who's running for president.
Wow.
I did that. Yeah, it was a pretty cool experience that I did it because I was focused on kind of what I saw as a really big credit cycle that had been brewing kind of ahead of the last cycle. So about, it's going back 2005, 2006, 2007, I started my first blog called Paranoid Bull because I was worried the markets were going to collapse. I've been blogging every day and tweeting every day since 2007. I've sent over 100,000 tweets because I'm very optimistic in the long run. And I happened to kind of meet a guy named John Paulson, who was working, to do the subprime trade at the time through my connections at Harvard Business School. So anyway, so I had, been trading on my own and was shorting and kind of expecting the crisis that came last cycle. But rather than continuing to do that, and I worked at a couple of large firms. I worked at Canyon, which is one of the largest hedge funds on the West Coast. And
let me ask you something about Paulson. Paulson came in before the hurricane hit in Puerto Rico and invested billions in Puerto Rico. I believe his expression was, especially with some of the new tax acts that came in there, that Puerto Rico was going to become the Singapore of the Caribbean. Does he still believe that? Do you know?
I'm still friendly with him and everyone at the firm. I'm not there anymore, obviously. And I think that it's kind of hard to know. I think these types of, I think that his view was a many year view. Like I don't think it was a kind of short-term view. I don't know. It's a short answer, and I don't think anyone can know.
Okay.
I do think that, anyhow, like last cycle, we got some things right being short, and then kind of got very long. And from, 2009 to 2015, I was actually very bullish, very long, kind of, a variety of different things, including private early stage companies. Even helped to build kind of private early stage company from scratch, backed by some of the Silicon Valley folks. So anyhow, so around 2015, I started to get worried about the cycle again. That's when I started tweeting under the Paranoid Bull handle. So I've been tweeting under that handle the last few years. Have been, running an investment firm called Oden River the last couple of years. And anyhow, I'm extremely bearish right now.
Okay, how was it to turn negative way early and have to deal with people who miss the upside?
Yeah, I mean, I think that the thing that happened, just to kind of complete the, just to give you a sense of the way I think about things and where I think we are today and what I think's happened since 2015. So I think in 2015, what happened was there's sort of there's two major cycles that matter. One is I'll call the credit cycle, which and I'm primarily domestically focused in the U.S. and primarily focused on, although I do kind of invest outside the U.S., primarily focused on individual securities. But what happens, from time to time when you have credit bubbles is you get defaults, meaning companies can't pay back their debt, they start to go bankrupt. And in 2015, we started to see a big wave of defaults. We actually saw the global economy start to slow down. China rolled over, and cyclical industry started to contract. In the U.S., default rates started to rise, and the U.S. equity markets hit like pretty important resistance levels. Well, the Fed at that time had a difficult decision to do. What they did is they decided to pause, and that's when the ECB went negative. BOJ did kind of their extreme, unprecedented QE, and China went ballistic with about $1 trillion in stimulus. So I think what happened at that time is they rather than having an ordinary credit cycle, what happened is they transitioned the cycle that we're in to a systemic cycle, meaning they took what would have been, a wave of corporate defaults that, we see every 7 to 10 years, and they've transitioned it to what I think is a wave of sovereign mispricing, meaning I think that the sovereign credit markets are obscenely mispriced. Political risk is the most important risk now, even more important than the fundamentals that we're seeing rolling over across industries.
Didn't they do the same thing in 08, 09? And if they had just let things unwind, we'd be coming out of it right now instead of facing potentially a bigger balloon.
Yeah, I think that what happened, yes, the short answer is yes. I mean, I think that the longer answer is that, I think that what we learned in 2008 was that systemic risk isn't just some theoretical idea that we hear about in textbooks. Meaning, in every financial textbook, there's this idea, they call it the risk-free rate, and there's these models, they call them CAPM and other models. And those ideas are based on this notion that there's some background systemic risk in the system that we need to compensate people for. In 2008, we learned that isn't just a textbook theory, it's an actual fact. Meaning, if credit bubbles get out of control, which is what happened leading up to 08, systemic risk can emerge, and it did. And so rather than recognizing that systemic risk is a product of the way things were set up, the institutions that were in place, the kind of way credit was allocated, the way that the credit bubbles developed, rather than kind of seeing that and modifying the system, what the central banks did, and specifically the Fed did, is bailed out the existing institutions, didn't really change much, and in some ways may have made things worse with some of the regulations that have been put in place since then, meaning Dodd-Frank created more illiquidity in the credit markets than existed before. What I mean is that they bailed out the old system, they then kept the incentives in place that created the last bubble, and then if you look at what's happened since 2008, since 2009 in the bottom, sure, markets are at all-time highs, but the credit bubble that we have this cycle is way bigger. The corporate debt bubble, the sovereign debt bubble, by pretty much any metric, debt is higher than it ever has been before. Same institutions, actually incentives are probably worse. We've got a lot more short-termism in the markets, a lot more kind of quantitative trading, not based on fundamentals. Passive investing is quite dangerous when it comes to market structure. So if anything, there's more systemic risk now than there was in 08. To your point, maybe the system could have cleansed, but it didn't. And now, unfortunately, we're facing a scenario where political risk is at the point where you really can't go a day without talking about it. I mean, between, even without the trade wars, I mean, if you look at what's going on in Europe, it's pretty extreme. If you look at what's happening with Italy.
What's the political risk in Europe?
The biggest political risk in Europe right now is that Lega, which is the leading party in Italy, has every incentive in the world to completely stand up to the European Commission in a way that Italy started to do last year but didn't. Meaning that Lega and the Italian people have been, well, basically Lega represents the Italian people, but Italy has been destroyed by the euro. If you look at what's happened, kind of going back, to prior to the European.
So the political risk is that Italy is one of the first to leave the eurozone.
They don't even have to leave. So if you go back to last May, May of 2018, there was a one-day rumor that Lega, which is the right, and the Five-Star Movement, which is the left, that is kind of in, they're both combined to control Italy today. So they've joined, basically the far left and the far right are kind of a populist coalition that are leading the Italian government today. There was a rumor they might call a snap election. That's it. And what happened is the Italian 2-year sold off 200 basis points in 2 days. And what that means is that it's not even just a theory, it's a fact that if political risk materializes in Europe, Draghi can lose control of the sovereign credit market. Now, why that matters is that the entire...
How do you trade it? You trade it with a short euro, your bias here?
So I think being short any of the Italian sovereign credit instruments, with BTPs in Italy, you can be short Spanish sovereign credit. You could be short euro. I think it's more levered to be short either European equities, specifically financials, or BTPs, or Spanish government debt. French government debt's also fine. If you do it through futures, you can kind of, play the spread, the BTP spread versus boons, or the Spanish government debt spread versus boons. I think doing it on an absolute basis, meaning just short the bonds is another way to do it, and kind of don't hedge the euro risk. I mean, to your point, the question of the euro versus dollar, there's some crosswinds in the short run, given what the Fed's likely to do, and kind of how bullish dollar has been. And
what do you think the Fed is going to do this week, David?
I think what they'll do is open the door to cuts. I don't think they'll cut this week. I think they'll but I think they'll start talking the market towards cuts in the next few months. I think it's probable that they'll begin cutting. I think it's quite unlikely to cut this week.
Okay, so let me ask you this. You talked about this happening in 2015, happened on a grander scandal.
Let me be clear about the difference between 2015 and today. So what I believe was likely in 2015 was that the credit cycle would turn, meaning we'd have a normal correction, like say, S&P 500 would be down 30%. We'd have maybe a mild recession. It didn't seem at that point that it was certain, or it seemed possible we might have a systemic type collapse like 08, but I think the likelihood was moderate at that time. I think today the likelihood is high that we will have a collapse on the order of magnitude of 2008. So I think things are far worse than they were when they began to normalize in 15. And the reason is because things were bailed out in 16 into 17. That the system, is actually at a much more precarious state.
Okay, how are we going to know that the next round of QE is not working?
So I don't believe it. So if you look at fundamentals today, so look back 2018, 90% of asset classes were negative, 90. Q4 2018, the GPIF, which is the largest pension fund in the world, had their worst quarter since prior to the dot-com crash. So the largest pension fund just had the worst quarter that they've ever had, basically in the last 20 plus years. In other words, the markets are already correcting. Well, in my opinion, what we've seen in Q1 this year is a bounce. I think it's kind of, people were getting negative into the end of last year. That Q1 has been a bounce. May was a bit of a normalization. And I don't think QE is working at all. If you look at end markets,
well, they haven't launched QE yet.
Yeah. So if you look at end markets, I think that fundamentals. So whether we look at export data coming out of Singapore last night at 30% year over year, we look at Korean export data down 30% year over year last month. We look at Chinese auto sales in May down 16% year over year. We look at semiconductors falling off a cliff. No matter, if you look at end markets, you look at German GDP is now projected to be in the contraction in Q2. Fundamentals are rolling over. Fundamentals are actually worse now. So
right. Which is going to be the catalyst and why the Fed is talking about starting to cut again. Well, my question was, if they've been successful in 08 and they were successful in 15, how are we going to know that they're not successful in 2019 through 2021?
Okay, so let's distinguish between 08 and 15, and then kind of explain why now is a little bit different. So 2008, first of all, the reason why they were able to do what they did is we were down extremely. We were down across all markets. We had systemic risk emerge. So in order to get, meaning the intervention that happened where the Fed bought assets, that is illegal. The Fed cannot do that without congressional authority. So, people who think, oh, the Fed's going to start buying stocks and buying bonds and kind of bail out banks, that is not possible today because the Fed does not have the authority to do it. So in 2015, it was a little bit different in that what happened was we started to get a credit cycle. What we got instead was the ECB started buying high yield bonds. The ECB went negative. The BOJ increased their quantitative easing and the Fed paused. Now the US wasn't as late cycle then as it was today. China also did quite extensive stimulus. And so what happened is you had kind of the business cycle or the credit cycle. They got extended. They got interrupted. We didn't get a complete clearing of the business cycle. So now, if you look at margins across industries, they're even higher than they were kind of coming into that. It was an attempted healthy correction, and it was interrupted. So we're now later cycle across every industry. The U.S. is actually later cycle. China's later cycle. And Europe's later cycle. So if you look at automotive, you look at semiconductors, you look at cyclical industries, margins got extended to record highs. Earnings got extended to record highs. Margins of the S&P 500 are at 12 on an operating basis versus last cycle they're at 8. So like 50% higher operating margins of the S&P 500. So they kind of kicked the can on a normal credit cycle, and because of that, I think this cycle is actually we're now past where we were at peak in 2008. Now, your question about what can they do once things get as bad as they were in 2008 and will it work? I don't know. I think it depends on how it breaks. If I'm right and it breaks in Europe, the reason why I think it's most likely to break in Europe, meaning the sovereign credit markets break in Europe, is that Draghi has limited control. The ECB is a political institution made up of a variety of different governments that have limited authority. Draghi can only hold 30% of any issue of government debt at any point in time. He can't just go out and buy as much as he wants without a negotiated outcome, which is why it's really important that Italy is fighting back against the European Commission, because Italy has to agree to allow the ECB to intervene in their credit markets. And they won't unless they get the fiscal stimulus that they want. And the Germans don't want them to have fiscal stimulus. So when you start to look at the details of how this thing might break, if it breaks in Europe and rates, they lose control of the markets there, and the financial system, which Deutsche Bank is screaming that their financial system's insolvent, if the financial system's actually insolvent and they try to bail out that financial system, which I think they would probably try to do, by the time these things start to happen, given how late cycle we are in the global economy, the U.S. equity markets are going to be down way more than they were last year. I mean, last year was nothing. We had a beginning of a normalization, and if we're down, let's say 30%, which is not, I think, I would call that like a moderate downturn given how high multiples are and margins are. If we're down 30% U.S. equities, and we're in a proper credit cycle, credit markets are down, like 20%.
What are the havens in that environment? Bonds, gold?
So I think, unfortunately, credit, being that short is the right positioning. I think that people,
Net short bonds as well because of sovereign debt problems?
That's exactly right. And rates, in my opinion, are too low, right? So it's like, the problem is there's nowhere to hide, like literally nowhere to hide.
Cash?
If you look at, so then we're getting into currency world, right? So I'm net short. I think the right thing to do, if you're, in my opinion, is to be net short. I think that gold could be a store of value. Things like Bitcoin, it's like a put option on fiat that's also a call option on technology risk. Like, I wouldn't suggest that people put a large portion of their portfolio in something as volatile as Bitcoin, but it is a put option, on an alternative. I do expect that gold's breaking out a little bit lately. I think that it shows you that people are concerned about all of the currencies. But again, I don't know that any of them are necessarily safe in the short run. That's why I'm net short. So I personally think being short is the safest haven that you could have in an environment where literally, every asset class is overpriced and risk is, increasing by the day.
Okay, so for the layman and not the expert, just be raising cash and
short-term
possibly.
US for a layman, I'd say this, FDIC insured, which is probably your best bet. Short duration, kind of treasury type yields of 2% are a godsend at this point. And
All right, let me ask you this. A lot of people think that our deposits at the banks are ours. We've had precedents in different countries of bail-ins. Could bail-ins happen here in the U.S. under those conditions?
I think that so let me just kind of say what I think is most likely to happen. I think what's most likely to happen is the markets will be down heading into the next election. Therefore, it's unlikely, as consensus as it is today, that Donald Trump will get reelected. If the markets are down in any way, like I'm suggesting, I think it'll be very difficult, for him to win. So we're going to have like a very contentious election going on if this stuff happens ahead of 2020. I do not think either side of this are going to let the individual account holders lose, meaning even if the FDIC is in a position, so Sheila Bair, the former head of the FDIC, came out last year saying she doesn't think the banks are capitalized enough. She knows what she's talking about. I don't know if she's right or wrong, but she sure as heck knows a lot. So let's say she's right and the U.S. banks aren't capitalized enough. I think that politically, whether it's President Trump or one of the other party kind of coming into office, I think politically they will bail out the account holders. They won't let individuals lose money. Now, what that means for the dollar, what that means for the markets, what that means for the equity holders of the banks, I don't think if we get into that scenario, the equity holders of the banks are going to be treated nearly as kindly as they were last cycle.
Okay.
But technically you're right.
There's no political will for a taxpayer bailout.
For the equity holders. But when it gets down to it, push comes to shove, and we have a fight on TV, between
the bondholders.
The individual account holders. To your point, I think technically you're right. There isn't a backstop beyond FDIC, and FDIC runs out of money. That backstop could go away. Then it's a political question, and I think the politics are either side, no matter who you pick, they're going to bail out the individual account holders. Now, what that means for the value of that currency, or the kind of what the world's going to look like at that time, I don't know. But that's why it's like not the safest house in the world.
Okay. So, I mean, the kind of environment you're talking about, especially with the type of divisiveness and anger in this country, do you think that it's not just going to be a financial thing? You talk about political. Are we looking at social unrest in the U.S. on this next crisis?
I think it's possible. I think that 2020, I call it the class warfare election. I think it's already underway. I think that if you look at what's happened since 2008, QE has really been to the benefit of the wealthy. It's just a fact. Central banks have inflated asset prices, and wealth inequality has gone up in each of these countries. And so, to me, it seems quite likely that, we're going to have kind of, we already have political unrest. I think we'll have.
So how are you preparing yourself and your family for what you believe and have conviction about?
So, I'm not short. I hate to suggest that folks should have a backup plan in terms of physically where they should go.
Do you?
Yes, I do.
Okay, interesting.
I have a physical,
go ahead.
we just have a physical plan nearby where we live, of a place where we know there's a generator and food, and I'm hopeful that we can avoid real unrest to the point of war. I think we can. I hope we can, but I personally have a plan. I've talked it over with my wife where we would go.
Okay. So you're prepping.
I am prepared.
Okay. And and you're going to stay in the U.S.
Yes.
Okay. And why is that? If you have the means to go to a place that
I don't know of any place that would be safer. And I
Really?
don't know that travel would be advised in a situation where we're having social unrest and have the risk of war.
Okay. Do you have an extra bedroom? All right, David. So definitely sign. Really, the alarm bells are ringing in this credit cycle because of the delays. We have to pay the piper, and how will we know? And we know the Fed's going to come out guns blazing, take rates down to zero again, maybe go negative. What's going to be our market tell that
when the
we have
equity market
problems?
sell off, when the Fed cuts and the market sell off.
And how about, and that they're at the bond market, which is looked at as
Credit
a haven,
Yeah,
rates go up, long-term rates go up, even though the Fed's trying to hold down short-term rates.
That's correct.
Would you look for that?
I think it's quite possible long-term rates rise. I think that they'll actually rally first and then fade. But yeah. Equity markets sell off. We'll get long-term rates rally, but once they start fading, and then credit volatility is the key move, the key tell.
Is this
CDS
deflationary? Is this deflationary or inflationary on the outcome? Do we bust first and then go into a hyperinflationary Weimar Republic thing, or is it 1930 all over again, where cash is king and it has great buying power?
So I think the asset markets will collapse, therefore, quote unquote, deflationary in the sense of asset prices falling. I think it could be inflationary in the sense of buying power becoming kind of worse. And so, yeah, I think it could be kind of a
stagflation,
stagflationary type environment. What happens from there is political. So I think it's going to be, unfortunately, we've delayed too long, and now we have to your point, pay the piper. There's consequences for actions, and now we're at that moment.
Okay, well, you lived up to your handle, paranoid bull, and maybe not so paranoid, maybe just not an ostrich with your head in the sand. So I really appreciate you spending some time and having a conversation with me today, my trading warrior brother. Like it or not, you are now, and appreciate you sharing your views. And this is the best place for people to follow you, David, at Paranoid Bull.
That's the best place to follow.
When are you going to start updating your blog again?
I really primarily do it on Twitter, but I'll consider updating my blog more if you think it's a good way to go.
Why don't you do that? Because I think you're going to be a great resource during this time, and maybe you gave up posting because everything was delayed because of what Europe did and China did. But
I just really Twitter. I enjoy Twitter. That's why.
Oh,
it's really easier. I tweet constantly, but it's.
Oh, okay. You're like me. I used to like to tweet, and now I have to tweet. So I'll see you at the next TA meeting.
That sounds good, man. All right.
Twitter Anonymous, David Levine. Thank you very much for being with us.
Thank you. All right, buddy. Have a great week.
All right, you too. Good luck on the Fed. So that's a wrap for us, everyone. Remember, don't just count your pips, count your blessings, and we'll see everyone tomorrow for Turnaround Tuesday. Good hunting. Adios.